Welcome to this explainer. Today, we're going to completely demystify the mechanics of value creation. Because, let's be honest, if you've ever wondered how top-tier organizations actually engineer value instead of just, passively calculating it, you are definitely in the right place. We're going to dive deep into the concrete frameworks and measurement tools that financial pros use to figure out if a company is truly growing in worth or if they're just putting on a really good show.
All right, here's our roadmap for today. We'll start with number 1, the value enhancement chain. Then move on to mastering economic value added. And then we'll look at the dark side of EVA. After that, we hit cash flow return, then CFROI feeding returns. And finally, we'll wrap up with the magic bullet illusion.
Okay, jumping right into section 1, the value enhancement chain, the blueprint for building value. Because before we can even think about measuring value, we really need to understand exactly where it comes from. Think of the value enhancement chain as your master blueprints. It's actual proof that firm value isn't just some abstract, mystical concept entirely dictated by the whims of the market. Actually, it's firmly rooted in discounted cash flow principles. Value is the direct result of very specific, manageable actions. Basically, to create value, you absolutely have to change one of the primary inputs that drive a firm's worth. And that really boils down to 4 core levers. If you're a manager or an investor trying to enhance value, any action you take absolutely must pull one of these levers. First, you can boost cash flows from your current assets. Think cost cutting or lowering taxes. Second, you can ramp up your expected growth rate by reinvesting capital at higher returns. Third, you can stretch out your period of high growth by building up lasting competitive advantages. Or fourth, you can lower your cost of capital, optimizing things like your debt to equity ratio. The bottom line, if an action isn't moving one of these 4 needles, it is literally not creating value. Moving on to section 2, mastering economic value added, measuring dollar surplus. Now that we've got the blueprint, let's pull out our first big performance measurement tool, economic value added, or EVA for short. What's really cool about this formula is that it shows us EVA is just measuring the actual dollar surplus a firm creates on the investments it already has. You just take the return on capital invested, subtract your cost of capital, and multiply that spread by the total capital invested. Put another way, it's your after-tax operating income minus your capital charge. It's a remarkably straightforward way to answer one question. Did our investments generate more cash than it cost to fund them? If yes, you've got a positive EVA. You're adding value in pure, hard dollars.
So the huge takeaway here is that EVA isn't some brand new mysterious concept. It's actually just a super practical extension of the classic net present value rule, or NPV. But where NPV looks at the massive total present value over the entire lifespan of a project, EVA takes that exact same concept and chops it down into digestible year-by-year performance chunks. Honestly, the net present value of a project is really just the present value of the EVA over its life. It just makes long-term valuation so much more accessible on an annual basis. But naturally, there's a catch. Section 3, the dark side of EVA, gaming the dollar surplus. Look, anytime you tie compensation to a specific metric, human nature takes the wheel, and things can get pretty messy. Now, here's a question for you. Can a manager completely crush their EVA targets but secretly destroy the firm's total value at the exact same time? Sounds totally contradictory, right? But this is literally the most critical question you have to ask when evaluating a company that loves to brag about its EVA growth. Well, the dark reality is, yeah, absolutely. It's the valuation game. Think back to that formula. EVA relies heavily on the capital invested base. So a manager could just aggressively slash reinvestment, maybe sell off some assets, and artificially shrink that capital base. Boom. Their immediate return on capital spikes, their EVA for the year looks absolutely brilliant, and they get a massive bonus. But by starving the company of future growth, they are systematically shrinking long-term cash flows and burning down the total value of the firm. It's a complete illusion of value creation. Which brings us to section 4, cash flow return, the real percentage return. To counter some of those dollar value distortions we just talked about, let's grab the second major tool in our tool belt, cash flow return on investment, or CFROI. We define CFROI purely as a percentage return tool. Its whole purpose is to strip away the noise, all those arbitrary accounting choices like depreciation schedules, and focus 100% on the real cash an asset actually generates relative to its gross investment. It simply asks, what is the real inflation-adjusted internal rate of return we're getting on the stuff we already bought?
Let's break down the mechanics here. Imagine you make a gross initial investment of $2.5 billion in year one. Then, that asset generates a steady $390 million in gross cash flow every year for its expected 7-year life, wrapping up with a final expected salvage value of about $607.8 million. The CFROI is just the discount rate that makes the present value of all those $390 million cash flows, plus the salvage value, perfectly equal to that initial $2.5 billion investment. Now, right about now, you might be thinking, hold on, isn't that just the internal rate of return? It's a great question, but the difference is absolutely crucial. Traditional IRR only looks forward. It takes the current market value and expected future cash flows and basically treats the original purchase price as a sunk cost that doesn't matter anymore. CFROI flips that script. It tries to judge management's actual track record by reconstructing the whole investment from the ground up, combining past sunk costs with future expectations. If your CFROI beats your real cost of capital, that's a massive green light that the firm is deploying assets effectively.
But CFROI isn't bulletproof either. Section 5, CFROI fading returns and reality checks, the vulnerabilities of percentage metrics. Just like EVA, if you rely blindly on a single percentage metric, you're opening yourself up to some serious blind spots.
If you're using CFROI, you absolutely have to account for something called the fade factor. You just can't assume a company making a 20% return today is going to keep doing that forever. Empirical data tracking thousands of firms over decades proves that extraordinary returns almost always fade back down toward the firm's cost of capital. Why? Because high returns act like a magnet for competitors. Unless a firm has an absolutely bulletproof competitive advantage, that fade is inevitable. Ignore it, and you'll end up massively overvaluing a company. And just as we saw with EVA, managers can totally game CFROI. If they slash their gross investment, the percentage return mathematically has to go up, right? It makes them look fantastic. But since they're investing in fewer projects, the firm's long-term dollar cash flow actually drops, so total firm value decreases. Or maybe they take on super risky projects to spike their short-term cash, bumping up the CFROI, but all that extra risk pushes up their overall cost of capital, which, you guessed it, destroys value. So, a rising CFROI percentage definitely does not automatically mean firm value is going up. And that brings us to our final takeaway for today. Section 6, the magic bullet illusion, strategy over formulas. This really resolves the whole debate over whether you should use dollar-based EVA or percentage-based CFROI. I absolutely love this quote from the source material because it grounds everything we've been talking about. At the end of the day, there are no magic bullets. Don't get me wrong, EVA and CFROI are incredibly useful diagnostic tools, but they are just tools. True value creation takes serious hard work. It's about building way better products, running superior marketing, making brilliant strategic decisions. You simply cannot financially engineer your way to lasting market dominance. So as we wrap up this explainer, I really want to leave you with this provocative thought to chew on for your own organization or the companies you invest in. Are the measurement tools you're relying on actually encouraging those 4 real levers of value creation? Or are they just a mirage, incentivizing people to engineer the metrics so they look like rock stars today, totally at the expense of tomorrow? Thanks for joining me on this deep dive into the Value Builders Toolbelt. Now get out there and keep pulling the right levers.